Joining us now is Matt Toole, Director of Deals Intelligence at Refinitiv. And Matt, welcome. Here's how I kind of view it. I mean, those numbers, if I just threw them up there, people might go, oh my gosh, a slowdown. But it feels like we went from 150 miles an hour on the highway to 130 miles an hour on the highway. By the way, don't do that unless you're on the Autobahn. But the slowdown is, correct me if I'm wrong, is from some pretty incredible numbers.
That's right, Brian. We saw the strongest year last year, over nearly $6 trillion of M&A last year, and I think looking at this year as a brief pause, we're still over $1 trillion. So it's been 7 consecutive years or 7 consecutive quarters of M&A over $1 trillion, which is the first time we've seen that since we began tracking M&A in 1980. So still highly elevated from historical levels.
Yeah, and is there a sign that the first quarter of this year is how the rest of the year is going to go, Matt? Or kind of like the stock market, we started off terribly, stocks sold off, we had Putin invade Ukraine, interest rates suddenly rose. All these things happened in just a couple of week period. I always tell people it's one of the more incredible times in a short period that we've experienced, or at least I have in a long time, and that the market, like everything else, just kind of paused. Do you think it'll reaccelerate, or is how the first quarter goes so the year goes?
I think the first quarter generally is one of the slowest quarters of each year. And so I think we will see M&A activity pick up because I think people are still assessing the new environment. So as you said, the beginning of the year from a stock market perspective was very volatile, uncertainty in the markets, interest rate rises coming in and assessing that kind of how that will affect financing. I think people are reassessing this new landscape and figuring out what their M&A playbook might be for the rest of the year. But generally conditions are still very, very favorable. And again, companies are looking to grow, they're looking to expand, and certainly with some of the factors that we have, particularly in technology and private equity, I would expect to see much more of that activity as we continue through 2022.
But didn't deal making, in particular private equity, boom so much in part, Matt, not because they're the smartest people in the room, although many of them may be, but because money was free. I mean, money was almost free and super cheap. And so you borrow money on the cheap at 1 or 2%. You buy a company, you extract the cash flow, you offer your investors a return, you rinse, wash, repeat. When rates are that low, it's kind of hard not to do deals and look smart, right? I mean, how much are higher rates going to hurt?
Yeah, I mean, the equation will change. And so, private equity buyers do have a mathematical calculation as to what makes sense for returns. And so, they've raised record levels of capital over the last 2 to 3 years. That can certainly be deployed. There's certainly innovative ways of structuring transactions, bringing in partners. Obviously, the bond market will still be, relatively attractive. Just, at some point that equation will change, and we don't know exactly when that will be, and we'll have to watch that quite closely because at some point the private equity buyers will back out because it just doesn't make sense anymore for them.